Okay, guys, today we're doing 7.3. We're talking about the cost of credit. Uh, what we're There's good and bad that comes with credit. Credit is a very powerful tool. If used improperly, it can lead to irreparable damage to your credit report. But if used properly, it can be quite lucrative. Okay. Now, having access to it can lead to overspending, and the overspending is what generally gets us into trouble. But if For me, if something is already in your budget, it makes sense to put it on the credit card. Because if I already have the money in my account to pay the credit off in full and on time, I can go ahead and actually use reward points to accrue cash or travel or things like that. Now, I'm actually referred to in the industry as what they call a deadbeat. Now, and normally you would think a deadbeat is someone who doesn't pay their debts back, but in the credit card industry, they make the majority of their fees and interests off people who do not pay on time and in full. If somebody uses their credit card, spends $2,000, pays it back within the grace period on time and in full, then no late fees and no interest gets charged. Okay, so let's talk about some of the charges that we're going to be getting. Finance charges can be broken into two different categories. We get charged interest for any balance that is overdue, and fees for any misuse of your card and or agreed upon charges. Now, there's two types. They're going to be fixed rate or variable rate. Fixed is um, an interest rate that's not going to change. Now, usually they'll send you something in the mail that says your rate is changing from this to that, and you have 30 days to accept it or decline. If you decline, they may close your account. Okay, but don't feel like you have to accept. You can always call up and negotiate. Um, and you can usually find another card that might have a better rate or better terms. Variable rates, now they fluctuate greatly. Um, Variable rates are good to have as interest rates are going down, which they are right now. They are not very good to have as interest rates start to ratchet up. They can change the interest rate for any number of reasons, whether it be changes to your credit score or any market interest rates. So if you're paying attention to what interest rates are doing, if you have to leave a balance on an account, just make sure that when interest rates are rising, you do your best to clear that balance up. Rates usually rise fast, but will fall slowly in a environment where interest rates are going down. It's similar like when gas prices go down. If they go down very quickly, if oil prices go down very quickly, airlines take a few months before they start to bring their prices down. Although in these times, they've fallen very fast because demand has fallen off a cliff. All right, now this will be listed in when you're looking for a credit card. One of these methods will be listed. Now, there's the adjusted balance method, previous balance method. This is kind of tough to find, but it's probably better for the customer. The average daily balance is the most common because it's the most complicated. Now, it can be the most expensive if you don't understand the technique. If you understand the method on how interest is calculated, it actually can be one of the cheaper methods. Okay, and we're going to take a look at the same spending activity calculated three different ways. And I know it's a lot, so you might have to pause the video, write some numbers down, take some screenshots, or do whatever you have to do. So let's take a look at adjusted balance method. Adjusted balance method. All right, it's very complicated, but I'll explain down below what's going on. There's a balance at the beginning of the period. Okay, so we rolled part of our balance. Maybe we owed $600, but we sent them $100 check. So now $500 will go to into the next month. It'll roll into the next month. Okay, so payment is received. It's subtracted to find the adjusted balance. Any charges made during the period are added. I forgot to mention that. Now, once we get to the adjusted balance, okay, it's the adjusted balance that gets the interest charged to it. So it'll make more sense with some numbers. So this is the balance that we didn't pay, and it rolled from 1 month into the next. Now, in the next month of May, we started to charge. On the 2nd, we charged $30. On the 6th, we charged $50. On the 21st, we charged $80. So we racked up a total of $160 in new charges. And once again, we could only send about $100 back to cover some of the spending. So our balance is starting to go up. So this new charges minus any payments is our adjusted balance. And this balance gets multiplied by the interest rate, and 18% seems high. I probably need to up this. Okay, most interest rates that you guys will be quoted will be in the mid 20s. Okay, so this is the adjusted balance. It gets multiplied by the 18%. So $8.40 of interest gets added to the adjusted balance, and this is the new balance that goes into the next period. Okay. Now, for me, I don't like this because technically the $500 was the only thing that you were really late on. All this new spending activity, you're technically not late on. You usually have till the end of the cycle and 25 days after, which is the grace period. So this method, if I see it quoted, I often avoid it. It doesn't make as much a difference to me because I never really carry a balance. I think in my life, I've only carried a balance twice. Now, previous balance method. Okay, previous balance method, interest is calculated using the outstanding balance. So if we look at the same situation, $500 wasn't paid from April. Okay, we spent $30 on the 2nd, $50 on the 6th, and $80 on the 21st, and that's $160 in new spending. This doesn't factor in. The interest is only charged on anything you were late on. So 18% of the $500 is only $7.50. Okay, it's not a huge difference, but it adds up if those balances become greater and greater. And the interest that's adding to your balance makes it harder to pay down and get back down to zero. So it's not a huge difference, but it is noticeable. So only being charged on what you're late on will add up a little bit. Okay, so previous balance method, if you see it, it's preferred. Now, the average daily balance is basically doing the adjusted balance method every single day. Okay, I can't really fit this down here, so what I have to do is I'd create a spreadsheet. One of the reasons why they use this method is you do need to put together a spreadsheet in order to calculate or check that they're charging you the proper interest. Most people are not going to do it, and that's one of the reasons why they prefer the method. Okay, so average daily balance, we're going to look at the same thing. We had a balance going into May of $500. On the 2nd, we purchased something for $30. On the 6th, we purchased something for $50. On the 21st, I think we bought something for $80. And then we sent them a check for $100. Let's call that on the 30th. So you can see that the interest rate here is the highest currently at $8.89. I know it's only a difference of a buck, but that's going to add up to more and more as our balances are allowed to grow. Now, one thing I can say, if you have this method, when you send them the $100 check or the $100 online payment matters. Okay, if we understand anything about the average daily balance, we want to bring down this average. So what we'd like to do, instead of sending them the money on the 30th, we know we're going to be late. We know we're not going to pay it in full, but let's pay it as soon as possible. So I'm going to pay it on the 10th. Okay, I'm not going to wait. Send them a $100 check early, and that lowers the balances of every single day. And that's going to lower the average daily balance. So now when we look down here, the earlier you send it, we just saved ourselves maybe a buck in interest by sending them the same check 20 days earlier. Okay, so average daily balance, when you send the check is extremely, extremely important. Okay. Now let's go into what they mean by the minimum payment. The minimum payment is how much must be paid each month in order to avoid a late fee. So if you pay the minimum before the grace period is over, within the 25 days since your billing cycle closes, they can't charge you any late fees. And late fees can be, $25, $35, or higher. I mean, they're pretty outlandish at times. It's where the industry makes a lot of their money. We want to set up an online bill pay so that their money is received in time to avoid the late fee. Now, the minimum payment, sometimes we might have an emergency that month, unexpected expense. We can't afford to pay the full balance down. I wouldn't recommend just sending the minimum. If you can go anything above the minimum, please do so. Okay, you don't want to have a lot of balance rolling from month to month with interest rates at what they are on credit cards. All right, so minimum payment is usually between 3 and 5% of the balance owed. Okay, so if you had $1,000 balance, well, 3% would be $30, 5% would be $50. So your minimum payment could be anywhere between $30 and $50, depending on your agreement, depending on the card that was issued to you. If you only pay the minimum, it could take you years to pay off the balance. Okay. And that's saying if I never use the credit card again and just spend or just pay the minimum every single month, it's going to take me years to pay off that balance. Most people don't use their credit cards that way. They're constantly spending and paying down and spending and paying down, adding to the balance and taking away. So this just doesn't make sense if you're going to be using your credit card a lot. Minimum payment does not help. So at least what we're going to do in those cases, we're going to do our 2010 rule, and we're going to max out at 10% of our net monthly income is what we want to pay towards any balances. Okay. Now, depending on your agreement, depending on your interest rate, you could end up paying more in interest than you paid for the item. We're going to be doing activities next week, and you're going to see some of the numbers, and they're pretty astounding. Now, payments, when you send them a check, some of it goes down to the principal. So in this example, if my balance was 1,000, that's considered to be my principal. The payments that I send in will go to pay interest first. So if the interest on this balance was $29 and I send them a $30 check, well, only $1 of principal is going to get paid down in that example. If my interest was $31 and I send them a $30 check, I'm never getting out of debt. Okay. So it makes a difference to pay more than the minimum. Okay. Now, penalties and fees. So a fee is something that was agreed upon. It's in your contract. Okay. So an annual fee is the common one. Annual fees are usually there on things like airline cards. You have an annual fee, but many times if you use the card the right way, that fee more than pays for itself in the perks or the reason why you got the card. Now, a penalty is a charge, or it's a fee that's a charge. It's a violation of your agreement. Okay, so if I'm late, I get a late fee or a late penalty. If I have a $1,000 spending limit and I go over that, okay, many times we're hit with a fee there as well. You got to really read the terms of this. Some of the cards operate differently. Some don't let you go over the limit, and if you are about to go over the limit, your card will be declined. Others allow you to go over the limit, but charge you $35 for each transaction over your limit. So be very, very careful. They could slap you with a $35 fee time and time again for each time you use your card over your limit. So please know what your limits are and know your contract inside and out. Okay, now teasers. Teasers are introductory rates to try to get your business. Okay, so many times they'll say 0% on balance transfers if you move a balance from one card onto their card, or 0% interest on all transactions for the first 6 months to the year But then once that grace period's over, it resets back to your normal industry rates. This is what they call a loss leader. They'll take a loss on the first 6 months or a year to get your business, and then hopefully once they get their business, they start to make that back on interest and late fees. Okay, so checking credit card statements, we're going to want to do this regularly. Okay, there are mistakes on there, so you can't always take your word for it. You should be checking all the time just to make sure there isn't any credit card fraud. If there is anything that's on there that you didn't do, you want to notify them immediately so you're not held responsible. But compare the charges listed on the statement with sales receipts and records of online purchases. Make sure that they are all known transactions and are for the correct amounts. Now, many times I've had problems in the past where, I've put a tip on a receipt at a restaurant, and the waiter or waitress has changed it. Okay, it doesn't happen often, but it has happened, and it's illegal. So we want to make sure that we're verifying. I usually keep all my receipts so I know, but I know some people are not as organized and can let that slip by. Now, verify payments that you have made and they show up on the statement. So if I mailed them a check, I know when I mailed it. I want to make sure that they got it. Or if I did electronic payment, I usually have an email confirmation of the day that the funds were sent. Okay, and I want to make sure that they've credited me properly. All right, verify any credits. So if I returned an item to a store and I got the money back on my card, okay, I want to make sure that was accounted for properly. I've had issues where there were errors in the past. I'd actually had pretty pleasant customer service responses from Discover. Now, take note of any fees or penalties that you've been charged. Okay, and you have your contract somewhere where you can find it, where you can determine was that valid? Were they allowed to charge me that? Okay, if not, we can dispute it. And now, this is really what we talked about today. We're going to verify that interest amount that's charged and new balances are in fact correct. If you know that you're going to have the adjusted daily balance method or the average daily balance method, you're going to want to create yourself a spreadsheet and verify that the transactions that they know are the transactions you know, and when they charge you interest, they're not overcharging you. The best way to not have to do this is to never carry a balance. Okay. Now, the last thing is if you do find errors, contact the company immediately. Many times, if there's a dispute, it's going to have to be in writing, either email or a letter. There's easier and easier ways to do this. I've found the times I have had to dispute, at least with my Discover card, I had a very good experience. When I had a Citibank card, I didn't have a great experience, but that was years ago, and maybe times have changed. Okay, guys, what you're going to be doing after this is we're going to do work and calculation for this next week. Today, I'd like you to take the time and try to get me your final project outline. Okay, if you've done that already, you can continue working on your script. We'd like to have that done within the next couple weeks. All right, guys, have a great day.